Hello, everyone, and welcome to Financial Market Insights for Traders. I'm Sophia, your host, and I'm thrilled to dive into today's topic with you. It's one of the cornerstones of smart investing and a timeless piece of advice that has helped countless traders safeguard their financial futures. That advice: don't put all your eggs in one basket. Today, we're talking about diversification, how to build a portfolio that's resilient enough to weather financial storms. Whether you're just starting out as a student of the markets or a self-taught trader looking for structure, understanding diversification is critical to protecting your investments and ensuring long-term success. Let's kick things off by exploring why diversification matters. Why diversification matters. Markets are unpredictable. Stocks can rise sharply one day and plummet the next. Bonds fluctuate based on interest rates and broader economic cycles. Cryptocurrencies, well, they can feel like a roller coaster driven by headlines, speculation, and technological innovation. If you put all your money into one asset, one sector, or one geographic region, you're exposing yourself to enormous risk. Diversification spreads that risk across multiple assets, sectors, and geographies, ensuring that no single market event can wipe out your portfolio. Think of it like building a ship with multiple watertight compartments. If one compartment is breached, the ship still stays afloat. Diversification is your strategy for creating resilience in your financial future. Statistically, diversified portfolios experience less volatility over time than concentrated ones. For instance, during the 2008 financial crisis, investors with diversified portfolios that included multiple asset classes lost less and recovered faster compared to those who held only equities. Now that we understand why diversification matters, let's explore what a diversified portfolio looks like. What does a diversified portfolio look like? A diversified portfolio combines a variety of asset types, such as stocks. These represent ownership in companies. Stocks typically offer higher returns but come with greater volatility. Within stocks, it's important to diversify across sectors like technology, healthcare, energy, and consumer goods. Bonds. Bonds are essentially loans you give to governments or companies. They provide steady income and carry lower risk. Bonds tend to move inversely to stocks, acting as a cushion during stock market downturns. Cryptocurrency. While high risk and high reward, allocating a small portion of your portfolio to digital assets can offer explosive growth potential without risking your core capital. Real estate. Investments in physical property or real estate investment trusts, REITs, provide income and value growth. Real estate often operates independently of stock market fluctuations. Commodities. Assets like gold, oil, and agricultural products can serve as protection against inflation and economic instability. Cash or cash equivalents. These provide liquidity and stability, ensuring you have capital ready to seize future opportunities or endure market downturns. Each asset type reacts differently to market conditions. Stocks might drop during economic uncertainty, while bonds gain value. Real estate can thrive even when other sectors struggle, and cryptocurrencies often chart their own unique course. Think global, not local. Let's shift gears to talk about global diversification. Another key aspect of portfolio resilience is not limiting your investments to your home country. Economic conditions vary widely across regions. A recession in one country doesn't necessarily spell a global downturn. For example, during Japan's lost decade of economic stagnation in the 1990s, U.S. stocks thrived. Similarly, emerging markets like India, Vietnam, and Brazil often experience rapid growth during periods of slower development in established economies. Investing globally spreads out country risk. Events like political instability, currency fluctuations, or regulatory changes can heavily impact domestic markets. A portfolio that includes U.S. tech stocks, European industrial companies, and Asian consumer goods manufacturers is inherently more robust than one concentrated in a single region. International exposure also taps into industries and innovations that may not be prominent in your home market. Ultimately, global diversification enhances returns and reduces volatility. How beginners can start diversifying. For those who are new to investing, getting started with diversification is simpler than it sounds. ETFs and mutual funds, Exchange-traded funds and mutual funds bundle dozens or even hundreds of stocks or bonds, offering instant diversification at a low cost. Look for total market or all-world funds to cover a broad spectrum of investments. Global funds. Some funds automatically invest across multiple countries and sectors. Sector funds. If you're looking for targeted exposure, sector ETFs allow diversification within industries like technology, healthcare, or energy. Small allocation to crypto. While speculative, a modest allocation of 1 to 5% to cryptocurrencies can add growth potential to your portfolio. For beginners, simplicity matters most. You don't need to own 50 different assets right away. Strategic allocation is far more important than sheer quantity. Risk management beyond diversification. While diversification is a powerful strategy, it's not the only way to protect your portfolio. Effective investment risk management incorporates several complementary tools. Setting stop losses. A stop loss automatically sells your asset when it falls to a predetermined price, minimizing potential losses. For example, setting a 10% stop loss below your purchase price prevents small losses from snowballing into major ones. Using a position sizing calculator, this tool helps you determine how much of your portfolio to risk on each trade based on your risk tolerance and account size. Proper position sizing prevents you from overexposing yourself to a single investment. Avoiding overleveraging. Leveraging, borrowing money to amplify trades, can magnify both gains and losses. Avoid excessive leverage, especially in volatile markets like Forex or crypto. Rebalancing regularly. Over time, market movements may shift your portfolio's allocation. Rebalancing ensures your risk profile remains consistent and locks in profits. Protecting your investments long term. Wealth building is a marathon, not a sprint. Protecting your investments means staying diversified, keeping emotions in check, and adhering to a clear strategy even during market turbulence. Regularly review and adjust your strategy based on life changes, like starting a new job, expanding your family, or planning for retirement. Using a combination of diversification, stop losses, proper position sizing, and realistic leverage limits creates a shield around your investments that withstands economic storms. Remember, the goal isn't to avoid losses entirely. That's impossible. The goal is to minimize catastrophic losses and remain invested long enough to benefit from long-term market growth. Tools and resources to help you. If you're serious about learning to avoid major losses or mastering risk management strategies, the right tools and resources can make all the difference. Start trading smart. Visit crystalballmarkets.com to explore their intuitive, beginner-friendly trading platform. It's designed to make trading easier and safer for newcomers. Level up your knowledge. Check out Crystal Ball Markets podcast series, where complex topics are broken down into simple, actionable steps. Final thoughts. Diversification isn't glamorous, but it works. It's one of the few free lunches in investing, a simple, effective way to boost your chances of long-term success. Whether you're managing €1,000 or €1,000,000, applying smart investment strategies can mean the difference between surviving market storms and sinking with them. By combining diversification across asset classes and global markets with disciplined trading practices, you can build a portfolio prepared to weather whatever financial challenges the future holds. Start small, stay consistent, and diversify with purpose. Your future self will thank you, not just for the returns, but for the peace of mind. Thank you for tuning in to Financial Market Insights for Traders. I'm Sophia, and I'll see you next time.